Did you know your $20 fast food meal used to cost just $10 a decade ago? Since 2014, the average price of fast food menu items has jumped by 63%, with some favorites, like those at McDonald's, doubling in price. For comparison, the average cost of eating out in the city has gone up 49% in the same period. So fast food inflation is outpacing even regular restaurants. Meanwhile, 78% of people now see fast food as a luxury, and most of us have been shocked by a bill recently. In this video, we'll break down the 3 big reasons why your favorite burger joint feels like a financial trap. From delivery app fees to rising labor and rent costs, we'll look at how the system turned quick, cheap meals into a wallet-busting disappointment. And it's not just about the price. Something else about fast food has changed, too. The broken promise of fast food. The original promise of fast food was simple, quick, affordable meals without the wait or the fuss. For decades, that formula worked. You could swing through a drive-thru, grab a burger and fries, and be back on the road in minutes. But that promise has eroded, and it's not just nostalgia talking. Industry data backs it up. Let's talk about speed. In 2014, the average drive-thru wait time was about 3.4 minutes. Fast forward to 2024, and that number has nearly doubled to 6.4 minutes, according to the InTouch Insight annual drive-thru study. That's not just a minor inconvenience, it's a fundamental shift in what fast food actually means. Even with some recent improvements, like the drop from 6 minutes and 19 seconds last year to 5 minutes and 29 seconds this year, the experience is still slower than what most people expect. But not all chains are created equal. Taco Bell, for example, has managed to keep its drive-thru times at an industry-leading 256 seconds, shaving nearly 23 seconds off its own average from the previous year. Meanwhile, Chick-fil-A, despite handling a massive volume of cars, still has some of the slowest average wait times at around 480 seconds. These numbers show that while some chains are making real progress, others are falling behind, and the gap between expectations and reality keeps growing. Industry-wide, drive-thru times have ballooned by 30% just since 2019, based on QSR Magazine's 2024 drive-thru study. The pandemic made things worse, but the slowdown started years before COVID-19 hit. In fact, McDonald's was already seeing slower service times compared to its own 2014 benchmarks. And now, with about 60% of orders coming in through digital platforms before customers even show up, the whole system is getting more complicated, not less. There's more to the story than just waiting in line. Customer service has taken a hit, too. The 2024 QSR Reputation ranking found a 6.9% increase in order mistakes and a 21.8% spike in negative comments about staff attitudes. Complaints about poor management practices have jumped by nearly 15%. Whether it's a wrong order, a cold meal, or an unfriendly interaction at the counter, customers are noticing the difference, and they're not happy about it. So why is everything so much slower and less reliable? One big factor is labor. According to CNBC, labor costs have risen faster than even food costs in recent years, with Jim Solera of North Coast Research noting that wage growth is outpacing historical averages. This has put pressure on franchise owners to do more with less. Many are running their drive-thrus with just 2 employees during off-peak hours, one person taking orders and payments, another assembling meals. That means a single worker might be juggling dine-in, drive-thru, and delivery tickets all at once. This staffing crunch isn't just about money. Fast food wages still lag behind other service industry jobs, making it tough to attract and keep employees. Turnover rates are sky-high, so restaurants are constantly training new, inexperienced staff. Chains that pay better, like Chick-fil-A in competitive markets, see lower turnover and faster service. But most locations are still stuck in a cycle of underpaying and understaffing. Menu complexity is another culprit. According to Nielsen data, the average fast food menu has doubled in size over the past decade. More options mean more ingredients, more custom orders, and more room for mistakes. Digital ordering has only made things more complicated, with customers tapping through endless customization options on their phones. Instead of a streamlined kitchen cranking out the same handful of items, workers now have to assemble a unique order for almost every customer. Even the physical layout of fast food restaurants is working against speed. Most drive-thrus still use single-lane designs from the 1980s, despite handling far more orders today. Some brands are experimenting with new concepts. Panera Bread has tested hybrid drive-thrus with heated lockers for mobile pickups, and Taco Bell's Defy locations feature 4 drive-thru lanes and vertical conveyors. But these innovations are the exception, not the rule. Legacy chains are slow to retrofit their real estate, so the majority of customers are stuck in outdated, congested lines. All these factors feed into a vicious cycle. Longer waits and worse service lead to bad reviews, which hurt sales. Franchise owners, in turn, cut labor even further to protect profits, making the problem worse. Some locations have even started locking their dining rooms during peak hours because they don't have enough staff to cover both the counter and the kitchen. It's a downward spiral that leaves everyone, customers and workers alike, frustrated. And here's the kicker. Despite the slower service and more frequent mistakes, prices keep going up. You're not just paying more in dollars, you're paying more in time, patience, and lowered expectations. The value proposition that made fast food a staple for millions of people is slipping away. So if you're wondering why that simple drive-through run feels like a test of endurance and your wallet, you're not alone. The industry's broken promise is now impossible to ignore. But the real shock comes when you see just how much more you're paying for the privilege. That $5 footlong at Subway now costs $12.99 in some locations. That's 160% inflation since 2008. The $20 burger lie. Let's talk about what's become known as the $20 burger lie. These days, grabbing a simple burger combo at a fast food chain can leave you staring at your receipt in disbelief. It's not just a handful of specialty items or trendy spots. Across the board, prices have jumped way past what most people expect from a value meal. The numbers are clear. According to Finance Buzz, fast food prices have risen by an average of 60% since 2014, while the Consumer Price Index for all items rose just 31% in the same period. That means fast food is inflating at almost double the rate of everything else you buy. McDonald's, for example, has more than doubled the price of some menu staples. The McChicken, which cost $1 in 2014, now sells for $3 at many locations, a 200% increase. Taco Bell's Crunchwrap Supreme, once $2.79, now goes for $5.29. Even Chick-fil-A's classic sandwich meal climbed from about $5 to nearly $9. These aren't isolated cases, they're part of a nationwide pattern. And it's not just about the big chains. Regional price differences can be shocking. A Shake Shack double cheeseburger costs $9.29 in Dallas and $12.50 in Manhattan. Airport and highway locations regularly tack on 20 to 30% more. These price hikes aren't simply a response to higher food costs. Grocery prices only went up by 31% in the same decade, while fast food menus soared almost twice as fast. What's behind this? The Bureau of Labor Statistics reports that fast food prices jumped 28% from 2019 to the first quarter of 2024, compared to a 19% increase for the overall CPI. So even as everything else gets more expensive, fast food is racing ahead. This has changed the way people think about eating out. In a LendingTree survey, 78% of Americans now consider fast food a luxury. Nearly 2/3 say they've been shocked by a fast food bill in the past 6 months, and 3 out of 4 believe it's cheaper to eat at home. Gone are the days of true dollar menus. Most chains have quietly replaced them with value bundles, or deals, that seem cheap until you realize the individual items cost much more than they used to. McDonald's, for instance, now advertises value meals starting at $3.99, which is 4 times the original dollar menu price. The idea of getting a full meal for under $4 is long gone. Even the so-called value options are just smaller portions at a higher cost per ounce. People notice. Social media is full of posts about $6 hash browns, $15 breakfast combos, and $18 chicken nugget boxes. But it's not just sticker shock. Customers are frustrated because they're paying more and getting less. The LendingTree study found only 13% of diners feel the food quality justifies these prices. In some cases, ingredients have actually gotten worse. Burger King switched to leaner, cheaper beef patties in 2021 while raising prices. Shrinkflation is everywhere. Large fries now come in smaller containers, drinks are downsized, and sandwiches are lighter than they were a few years ago. Meanwhile, corporate profits are up. McDonald's profit margins grew from 16% in 2012 to 23% in 2022, according to their own financial reports. Chains like Yum Brands, which owns Taco Bell and KFC, regularly report strong earnings and highlight strategic price increases to their investors. These companies aren't just passing along higher costs. They're using pricing power to boost margins and reward shareholders. The pandemic only sped things up. While labor shortages and supply chain issues were real, industry analysts say wage increases explain only about 20% of the total price hikes. Chains used COVID-19 as a reason for aggressive price jumps, and those prices never came back down. Internal documents from major brands show executives openly discussing how to test the limits of what customers will pay, using inflation as cover. Delivery apps have made things even worse. That $10 burger can easily become $15 or more after delivery fees and markups. Restaurants know that people using apps will pay extra for convenience, so the higher prices stick around even for in-store customers. Sometimes you'll even find different prices at the drive-thru, the counter, and in the mobile app, all for the same meal. The menu itself has gotten more confusing. Value bundles often cost more than buying items separately, if you actually do the math. Limited time offers appear at premium prices and then stick around, normalized by customers who have gotten used to paying more. Add-ons like bacon or guacamole, once 50-cent upgrades, now run $1 to $3 each. It's all about finding ways to nudge the average ticket higher. Younger generations feel this the most. Millennials who remember $1 burgers in college now see $6 versions of the same item. Parents post videos showing $50 McDonald's receipts for basic family meals that used to cost less than half that. For minimum wage earners, a single combo meal can mean nearly an hour of work after taxes. The value proposition that made fast food a staple for working families is disappearing. This change has shifted how people use fast food. When a Whopper meal costs $13, customers start comparing it to local diners or fast casual places that offer better quality for similar money. Fast food's core advantage, being the cheapest, fastest meal in town, is fading. Certain chains have leaned into this, targeting wealthier demographics and positioning themselves as premium options. McDonald's has even opened test locations for upscale drinks and menu items, chasing the Starbucks crowd. Taco Bell now offers $16 steak burrito bowls to compete with Chipotle. Franchise owners are feeling the squeeze too. Many report that higher prices have driven away regulars, with customers cutting visits from several times a week to once a month. Lower sales volume forces some to raise prices even more to stay profitable, creating a cycle that's hard to escape. Some franchisees push back against corporate-mandated price hikes, worried it's hurting their local business. There's also the issue of portion cuts. The large fry now fits in what used to be a medium container. Chicken sandwiches are smaller by weight, and orders come with fewer nuggets. According to USDA data, chicken sandwiches shrank by an average of 12% since 2016, even as prices soared. Discounting has dropped, too. Chains have reduced coupons and promotions by 40% since 2018, according to in-market data. App deals exist, but they often require jumping through hoops or spending more to unlock a real discount. International comparisons make the situation look even worse. The same Big Mac that costs $5.17 in the US can be found for $3.75 in Canada or $2.29 in South Africa, after adjusting for currency. US fast food is now among the most expensive in the world, despite lower ingredient and labor costs compared to many other countries. Corporate strategy documents reveal the thinking behind these moves. For example, a leaked Wendy's memo discussed surgical pricing increases targeting items popular with lower-income customers, betting that wealthier diners wouldn't notice. McDonald's investor briefings talk openly about pricing power, raising prices beyond what's needed to cover inflation, simply because the market will bear it. Even workers can't afford the food they serve. At $15 an hour, a McDonald's employee has to work nearly an hour to buy a combo meal after taxes. Many bring food from home, since even with an employee discount, the menu is out of reach. The irony isn't lost on anyone. Customers are responding. Many are trading down to smaller items or skipping fast food altogether. People who used to eat out weekly now go monthly or switch to grocery store frozen meals for a better deal. Fast food's role as an affordable indulgence is fading fast. But there are signs of pushback. Chains are finally seeing resistance as more customers hit their price limit. McDonald's recently reported sales declines tied to price fatigue. The $20 fast food meal might finally be too much for many people, but don't expect prices to drop significantly anytime soon. With profit margins at record highs, these companies have little incentive to roll things back. So the next time you see a $20 burger combo, remember, it's not just about inflation. It's a web of corporate strategy, shifting menus, and pricing games that have changed the landscape of fast food. But the menu price is only part of the story. There's another reason your meal costs so much more than it used to, and it's hiding in plain sight. Delivery app fees, the hidden tax. Ordering fast food through delivery apps like DoorDash, Grubhub, or Uber Eats has become the new normal for millions of people. But that convenience comes with a price that most customers don't realize until they see the final total. Welcome to the hidden tax of delivery app fees, a system that quietly adds 23% to 30% to your order, not including tips, and leaves both diners and restaurants wondering where all the money goes. Let's look at how it plays out. Say you order a $12 combo meal from your favorite burger chain. On a delivery app, the restaurant often lists that same meal for $14.25, about a 24% markup, according to data from Money Talks News. That's before you even get to the checkout. Once you add in a service fee, regulatory fee, delivery charge, and taxes, your total can easily hit $22 or more. And that's still before the tip. The Finance Buzz experiment found that the average delivery order costs 126% more than picking up the same meal yourself. In other words, a $12 meal can balloon to $27 or $28 with just a few taps on your phone. It's not just about the extra fees. Restaurants face a tough choice. Either raise their menu prices on delivery apps or lose money on every order. Third-party delivery platforms typically take a commission of 15% to 30% per order, depending on the contract and the size of the restaurant. For many small businesses, these fees wipe out their already thin profit margins. Some independent restaurants report losing $3 to $5 on every app order after accounting for all the fees. That's why so many places now offer in-house delivery or discounts for ordering directly. They're trying to keep more of your money and give you a better deal. Chains aren't immune either. While large brands like McDonald's and Chipotle can negotiate lower commission rates, they still face the pressure to offset delivery fees by raising prices for everyone, including walk-in customers. The Cheesecake Factory, for example, admitted to adding 50 cents to every menu item chain-wide to cover the cost of delivery app commissions. So even if you never use delivery, you're still paying part of that hidden tax. The fee structure itself is confusing by design. Delivery apps break up the total into a long list of charges: service fees, small order fees, regulatory fees, and even busy area surcharges during peak times. A viral TikTok recently showed a $12 sandwich turning into a $29 order after 7 separate upcharges. During big events or bad weather, surge pricing can push fees even higher. It's hard to know what you're actually paying for, and most customers don't realize how much the fees add up until it's too late. Despite these costs, delivery demand keeps rising. DoorDash reported an 18% increase in orders year over year in 2024, and Uber Eats saw a 16% jump in delivery bookings. Even as more people complain about the price, the lure of convenience is hard to resist. But that doesn't mean people are happy about it. According to the American Customer Satisfaction Index, food delivery apps score a 73 out of 100, significantly lower than full-service restaurants, 84, or even fast food chains, 79. Uber Eats leads the big names with a 74, but none of the major platforms break into the high satisfaction range. Restaurants try to fight back in creative ways. Some offer pickup incentives, like free desserts or discounts if you order directly. Others list, "This meal $12 if you call us direct," on their delivery menus, daring customers to spot the difference. A few even tape notes to app orders, pointing out how much you could save by skipping the app next time. In Portland, one diner started shipping cold DIY meal kits through Uber Eats, so customers finish cooking at home and avoid the delivery markup. Delivery drivers aren't winning either. The rising fees don't all go to the people actually bringing your food. According to TransUnion data, Average delivery costs have increased by 32%, but driver earnings haven't kept pace. Many drivers report making less than minimum wage after accounting for gas and expenses. Tips, which the apps push aggressively at checkout, often end up subsidizing the platform's profits rather than rewarding good service. And with more drivers competing for orders, the average payout per trip keeps shrinking. There's another layer to the delivery fee puzzle: menu inflation. As more orders come through apps, restaurants raise their base prices to cover the costs. When 40% of a restaurant's sales come from delivery, even dine-in customers end up paying more. Menu data shows that delivery-only ghost kitchens have popped up to meet demand. These are kitchens dedicated solely to fulfilling app orders, often with lower quality ingredients or smaller portions. DoorDash and other platforms have launched their own virtual brands, selling pre-made meals under different names to maximize their share of the market. Food quality suffers too. The average delivery meal arrives nearly 40 minutes after cooking, compared to about 8 minutes for pickup. Cold fries, melted milkshakes, and soggy sandwiches have become the norm. According to a ChatMeter study, wait time complaints spiked 8.5%, and app-related complaints jumped 52% as more people turned to delivery. But the apps rarely hold restaurants accountable. Your one-star review doesn't affect their rating on the platform, and there's little recourse if your meal arrives in bad shape. Some restaurants try to avoid the worst of it by listing themselves as closed on delivery apps during slow periods or by steering customers toward cheaper direct ordering. But for many small businesses, opting out means losing up to 60% of their sales. The system leaves them stuck between high fees and lower profits, with little room to maneuver. Even the delivery apps themselves aren't always profitable. Uber Eats and DoorDash have struggled to turn a profit after paying drivers and spending heavily on marketing. Their solution: more fees and new charges. DoorDash now charges restaurants for priority placement, in-app search results, and offers customers a $9.99 monthly plan to reduce fees, which still leaves you paying 15% to 20% more than pickup. It's a cycle that keeps pushing prices higher for everyone involved. The psychological tricks don't stop at fees. Apps default to suggesting 20% to 25% tips on the post-fee total, not the food cost. That means you're tipping on the inflated amount, not just the meal. Some apps now offer priority delivery for an extra $1.99, which just means your order isn't intentionally delayed. These small charges add up quickly, normalizing the idea of paying $30 for what used to be a $12 meal. The environmental impact is another hidden cost. Individual delivery orders generate 3 to 5 times more carbon emissions than in-person dining, as drivers crisscross cities to drop off single meals. In New York City alone, daily delivery traffic is equivalent to 6,000 extra cars circling Manhattan. While apps could bundle orders to reduce emissions, they prioritize speed and more fees over sustainability. There are signs of pushback. Some cities, like New York and Chicago, have tried to cap delivery fees or require apps to share customer data with restaurants. But most reforms have been temporary or quickly overturned by industry lobbying. Meanwhile, new models are emerging. Some startups let restaurants sell discounted surprise bags of leftover food for pickup only, and traditional pizza shops are seeing a resurgence as customers seek straightforward pricing and in-house delivery. Younger consumers are beginning to reject delivery fees, with under 30 ordering frequency dropping 18% last year. Influencers promote app detox challenges, showing how much you can save by cooking at home or picking up your own food. As more restaurants create better direct ordering options, there's hope that the middlemen might finally get cut out. Still, for now, the hidden tax of delivery app fees remains a major driver of fast food inflation. It's a system that benefits the platforms most, while squeezing restaurants, drivers, and customers alike. And as prices keep climbing, labor costs, the question becomes, workers can't afford who actually can afford to eat. The reality for fast food workers is stark. Rising labor costs are driving up menu prices, but the people preparing your food are often priced out of eating it themselves. In California, where the minimum wage for fast food employees recently jumped to $20 an hour, a McDonald's combo meal can represent nearly 2 hours of pre-tax work. At Chipotle, a worker needs to log about 51 minutes just to buy a burrito bowl with guacamole. The numbers add up quickly. With Wendy's new $20 minimum wage in California, A full 8-hour shift nets around $150 after taxes. A Baconator meal with fries and a drink costs $12.79 at those same locations. So one lunch break can eat up 8.5% of a day's earnings. The higher wage sounds like a win until you see that prices at these chains jumped 8% overnight to offset the new labor law. Labor costs now account for 25 to 35% of fast food operating expenses, up from 18 to 25% before the pandemic, according to CNBC. Analyst Jim Solera notes that labor cost increases are still outpacing historical averages, even as other costs like ingredients have stabilized. Yet, despite these wage hikes, most fast food workers continue to live paycheck to paycheck. Their raises are often offset by the very menu price increases designed to cover higher payrolls. Regional pricing differences make this clear. A McDonald's quarter-pounder meal costs $8.29 in Texas, where the minimum wage is $7.25, but jumps to $10.89 in California. After the $20 minimum wage law passed, Chipotle raised prices in California by 7.5%. Wendy's followed with an 8% hike. Rather than spreading these costs nationwide, chains target price increases where wages rise most steeply. Workers themselves describe the struggle. One Jack in the Box employee in Los Angeles told reporters she spends $100 a week on groceries because eating at work would cost $15 per meal. A Five Guys worker in Seattle calculated he'd need to work 2.5 hours to afford his own bacon cheeseburger, fries, and drink. Many bring simple sandwiches from home while serving $9 milkshakes to customers. Brands often claim these price hikes are unavoidable, but their financials tell another story. Labor costs have risen about 20% since 2020, but menu prices at most chains have climbed 50 to 100% in the same period. Yum Brands, which owns Taco Bell and KFC, reported record profits of $1.6 billion last year, while publicly citing labor pressures as a reason for further price increases. Investors praise chains like Wingstop for successfully passing 100% of wage inflation onto customers. Service quality has suffered as a result. According to Chatmeter's 2024 QSR reputation ranking, complaints about order mistakes have increased by 6.9%, and negative comments about staff attitudes are up 21.8%. Workers are often stretched thin as management tries to hit strict labor targets. One Burger King franchisee said they had to cut dining room hours because they couldn't afford enough staff to cover both the counter and the drive-thru at higher wage rates. The psychological impact on staff is real. Many workers spend their shifts surrounded by food they can't afford to eat. Some report feeling embarrassed bringing packed lunches while serving $16 combo meals. In some locations, employees are banned from eating during shifts to avoid conflict, meaning they have to clock out and buy the same food at full price, often with money they can't spare. Corporate strategies often put profits ahead of workers. Internal documents show companies targeting price increases on items popular with lower-income customers to offset wage hikes. Some chains have tested reducing portion sizes while keeping prices the same. A 20% bigger burger promotion might end, but the higher price stays. The goal is to protect executive bonuses and shareholder returns, rather than absorb the cost of paying workers more. The idea of a living wage doesn't always hold up. Workers may gain $4 an hour on paper, but lose $6 an hour in real purchasing power as menu prices outpace their raises. In fact, fast food salaries peaked in the late 1970s when adjusted for inflation. Today's $15 to $20 hourly rates by less than minimum wage did back then. Workers fight for raises, win them, and then see corporations reclaim those gains through aggressive menu pricing. Some franchisees push back against corporate mandates. In California, several McDonald's owners voiced concerns over the $20 wage, warning they could go out of business. Some proposed capping entry-level pay at $18 and allocating the rest to experienced staff. But even these suggestions are often undermined when corporate requires franchisees to implement 15% price hikes to cover higher labor costs. Delivery apps add another layer to the problem. With 30% of orders now coming through platforms like DoorDash and Uber Eats, restaurants must pay higher wages to staff handling more complex digital orders. Those labor costs get passed onto everyone, so even if you walk in to order, you're helping to fund the higher wages needed to keep up with delivery demand. Consumers are noticing. Complaints about fast food prices rose nearly 40% in 2023, according to Chatmeter. In California, 62% of people say they visit fast food restaurants less often due to the cost. As $20 meals become more common, customers start to question why they wouldn't just choose a sit-down restaurant with better food for a similar price. International comparisons highlight the contradictions. In Denmark, McDonald's workers earn about $22 an hour with full benefits, but a Big Mac costs only $4.90, less than in the US, where the average is $5.17. In Australia, fast food workers make $15 to $21 an hour, yet meals cost 20 to 30% less than in the US. The difference? Corporations in those countries accept lower profit margins, rather than passing every cost increase onto customers. Many fast food workers are stuck in the system. The flexible schedules fit around school or family obligations, making it hard to switch jobs. Union representation is rare. Only about 1.2% of fast food workers have collective bargaining rights. Companies count on high turnover to keep training costs low, rather than investing in staff retention or better benefits. Meanwhile, the disconnect between price and quality keeps growing. Americans now pay premium prices for fast food burgers made with what the USDA calls commodity-grade beef. Chicken sandwiches are often made from lower-grade woody breast, fillets that grocery stores reject. Yet, the workers preparing these meals are still unable to afford them. Some chains prove that alternatives exist. In-N-Out pays $18 to $22 an hour in competitive markets, but a double-double burger still costs just $4.50. Costco's $1.50 hot dog combo has stayed the same price for nearly 4 decades, even as wages have risen. These companies show that it's possible to pay workers more without resorting to predatory price hikes, if corporate profits take a modest cut. Wider economic trends only add to the pressure. Fast food wages have risen about 40% since 2014, while overall inflation is up 31%. But fast food prices have jumped 100% in the same period. In many areas, housing costs have doubled, so even with higher wages, workers fall further behind in terms of real purchasing power. Corporate spending priorities make things clear. McDonald's spent $2.3 billion on stock buybacks last year, enough to give every U.S. employee a $4,300 raise. Meanwhile, franchisees face their own set of challenges. McDonald's owns 45% of the land and 70% of the buildings its restaurants occupy, according to Your Story. Franchisees pay 8 to 15% of their sales in rent, based on Wall Street Survivor's analysis. The typical franchise agreement requires a $45,000 franchise fee, 4 to 5% royalties, and rent calculated as a percentage of sales, as detailed by Investopedia. The average McDonald's franchise profit is about $150,000 per year, while McDonald's corporate nets around $290,000 per store. Franchisees often feel squeezed between rising labor costs, high rent, and strict corporate requirements, leading to tension reflected in ACSI franchise satisfaction scores. Many express frustration that, despite record system-wide profits, their own margins are shrinking. This system didn't happen by accident. In 1956, Ray Kroc's Franchise Realty Corp. began buying land and buildings, then subleasing them to franchisees at a markup. This model, still in place today, ensures steady revenue for the corporation, even when franchisees struggle with rising costs. As labor costs and menu prices keep climbing, it's not just workers and franchisees feeling the squeeze. The real question is who benefits most from the current setup, and where all those extra dollars are actually going. Corporate greed, the real menu price driver. When people talk about why fast food prices keep climbing, the conversation usually circles around rising wages, ingredient costs, or supply chain problems. But the biggest driver is something most customers never see: corporate greed, baked right into the business model. While companies point to inflation and wage hikes as reasons for menu increases, their financial disclosures tell a different story. One where profits and executive compensation keep hitting new highs, even as customers and workers feel the pinch. Take Restaurant Brands International, the parent company of Burger King and Popeyes. Last year, their CEO made $40 million, enough to give every Burger King worker in the U.S. a $175 bonus, but that didn't happen. Instead, menu prices went up, and portions shrank. McDonald's posted $8.7 billion in profit, up 59% from 5 years ago, while raising Big Mac prices by 83%. These aren't isolated cases. Across the industry, profit margins have soared well beyond what's needed to cover higher costs. Corporate earnings calls and investor presentations reveal the strategy. Yum Brands, which owns Taco Bell, and KFC, told shareholders they achieved 4 straight years of 4% or higher same-store sales growth through strategic pricing. In plain English, they kept raising prices even after their own expenses stabilized, simply because customers kept paying. Wendy's earnings reports mention price optimization technology that adjusts menu costs in real time based on what each neighborhood will tolerate. This isn't about covering costs, it's about charging as much as possible, wherever possible. The gap between executive pay and worker wages is staggering. The average fast food CEO now earns 1,300 times more than their median employee. McDonald's CEO Chris Kempczynski took home $17.8 million last year, all while arguing that franchises couldn't afford $15 minimum wages. That's the equivalent of 924 full-time minimum wage workers' yearly pay. Meanwhile, McDonald's franchisees reported record-high average unit volumes of $4.1 million per location, showing that money is flowing in at every level, just not to the people making the food. Profit margins in fast food dwarf those in other industries. McDonald's maintains a 23% profit margin, while grocery stores operate on 1 to 3%. Even airlines, famous for charging extra for everything, average just 5%. Yet fast food chains claim they're forced to raise prices by rising costs, all while their per-order profits increase. For example, a $10 combo meal that costs a franchise $5.50 to make now sells for $14, a 250% markup, compared to 180% in 2019. Franchisees are often frustrated by these corporate decisions. Leaked communications reveal owners complaining about being forced to raise prices and invest in expensive upgrades, like $15,000 digital menu boards, which then justify a 20% hike in combo meal prices. Some McDonald's franchisees even sued corporate over excessive fees and restrictive purchasing requirements, arguing that these policies prioritize shareholder returns over local business sustainability. Menu design is a psychological game. Chains introduce premium items at high prices to make regular menu items look more affordable. When McDonald's adds a $7 specialty sandwich, suddenly the $5 Big Mac feels like a deal. KFC tested a $49.99 family bucket in select markets, conditioning customers to accept $30 as the new normal for a family meal. Wendy's CFO described a barbell pricing strategy. Keep a few low-cost items to claim value, but push most prices higher. Stock buybacks are another sign of where priorities lie. In the last year, fast food companies spent $14 billion buying back their own shares instead of lowering prices or investing in better food. McDonald's alone spent $2.3 billion on buybacks, enough to give every crew member a $3,000 raise. Yum Brands returned $1.9 billion to investors while raising Taco Bell menu prices 18% since 2021. Ingredient costs don't tell the whole story, either. When commodity prices drop, customers rarely see those savings. Coffee beans fell 24% last year, but McCafe lattes still got more expensive. Beef prices dropped 9% in 2023, while burger prices rose 6%. Industry financials show that food costs as a percentage of sales actually declined at most chains, even as labor and delivery fees inched up. The National Restaurant Association admitted that ingredient inflation slowed to just 1.2% this year, but menu prices still climbed 6%. Delivery apps have become profit machines for big brands. When you order through DoorDash or Uber Eats, chains often raise menu prices on the app, pocketing the difference while pushing delivery costs onto franchisees. Some restaurant groups run multiple virtual brands out of a single kitchen, doubling their reach without hiring more staff. Delivery app algorithms favor these higher-priced ghost brands, increasing revenue for corporate while customers pay more for the same food. Value menus aren't what they used to be. McDonald's advertises $1, $2, and $3 deals, but the $3 option usually requires buying multiple items. Taco Bell's value menu now averages $2.49 per item, up from $1.29 in 2019. If value menus kept up with inflation, there would be 88-cent items today, but instead corporations shrink portions and raise prices. For example, Wendy's sells a 4-piece nugget for $1.29, while the 10-piece option costs $3. Executive bonuses are tied directly to profitability. At McDonald's, 65% of executive compensation depends on hitting profit targets. It's no surprise that corporate leaders squeeze franchisees and customers to boost margins. Internal documents from other chains show district managers earning large bonuses based on sales growth and margin expansion, much of which comes from raising menu prices. Franchisees have little control over pricing. Contracts often require corporate approval for any price change above a certain threshold. One Burger King owner shared a clause mandating corporate sign-off for any price adjustment over 10%. When a Whataburger franchise in Texas tried to freeze prices. During inflation, corporate forced compliance with nationwide hikes. The franchise model now resembles a system where corporate profits are driven more by selling locations and collecting fees than by selling food. Some chains use dynamic pricing to maximize revenue in low-competition areas. Internal analytics identify price-insensitive customer groups, often in low-income neighborhoods where fast food has no real competition. A Wendy's in Detroit might charge 18% more than a suburban location for the same meal. McDonald's even patented technology to adjust drive-thru prices based on your car model, though they claim not to use it. Brand loyalty is carefully engineered for profit. Starbucks proved customers would pay $7 for coffee if prices rose gradually. Fast food brands follow suit, knowing that millennials remember $1 burgers, but Gen Z only knows $6 versions. Marketing budgets keep climbing, with McDonald's spending $800 million a year to reinforce the idea that higher prices mean better quality, even when the food hasn't changed. Discounts and loyalty programs are more about increasing spending than saving customers money. App coupons often require buying high-margin items, like large drinks, to unlock a deal. Loyalty programs encourage upsizing and add-ons, increasing the average order value. Taco Bell's rewards program led to a 28% jump in average ticket size after launch. Pandemic disruptions gave chains cover for permanent price resets. While COVID-19 did increase costs for a while, most chains now report profits above pre-pandemic levels. A Wendy's executive admitted that the pandemic allowed them to reset customer price expectations permanently. Research shows that only about 27% of recent price increases are tied directly to higher costs. The rest flow straight to corporate earnings. Small towns and rural areas often see the steepest markups. A McDonald's in rural Alabama may charge more for a Big Mac than one in Chicago, despite lower rent and labor costs. With little competition, corporations can set prices as high as the market will bear. Dollar General stores with fast food counters also charge more in areas with limited options, leading to higher profit margins and more customer frustration. Ghost kitchens and virtual brands add another layer to the pricing game. Chains like Mr. Beast Burger can sell $12 delivery-only burgers from shared kitchens because customers don't see the real source. A single facility might host multiple brands using the same equipment, offering identical food at different price points. Restaurant Dive reports that Taco Bell's Defy concept is one of the few exceptions, with new layouts designed to streamline drive-thru service and improve efficiency. Regulators are starting to pay attention. The SEC has subpoenaed several chains over potential collusion in pricing software. Many brands use the same third-party platforms to analyze competitors' menus and recommend synchronized price hikes. When all the major players in town raise prices at the same time, it's not just inflation, it's algorithm-driven coordination. Meanwhile, actual restaurants are falling into disrepair. Franchisees report deferred maintenance and aging equipment as corporate demands more profit. KFC owners have shared images of broken freezers and leaking ceilings, while being told to prioritize royalty payments over repairs. McDonald's franchisees spent $400 million last year on mandated remodels, only to be required to invest another $200 million in technology upgrades, even as rent and fees rose. Corporate design choices also play a role in maximizing profit. Since McDonald's piloted its modern prototypes in 2010, about 90% of locations have adopted standardized facades by 2020, according to industry reports and ACSI photo surveys. Statista data shows these uniform designs reduce construction costs by about 30%. Design consultants note that uniform branding not only simplifies operations, but also cuts overhead and speeds up new store openings. Only a few concepts, like Taco Bell's Defy, break the mold by experimenting with drive-through innovations. These standardized choices aren't just about aesthetics, they're tightly linked to the economics of the business. Corporate pushes for cost-saving designs, streamlined operations, and real estate efficiencies all feed back into the same cycle of profit maximization. This approach has reshaped not only what you pay for your meal, but also the very buildings where you buy it. Understanding how these decisions play out at ground level means looking beyond the menu and into the foundations of the fast food business itself. The next time you pull up to a drive-thru, what you see is just the tip of a much larger structure. One built on a different kind of asset entirely. The real estate shell game. Behind the counter and beyond the menu boards, the fast food industry's real engine is real estate, especially at McDonald's. Harry Sonneborn, McDonald's first CFO, made it clear decades ago. The company's real business is collecting rent, not just flipping burgers. This rent-based model, detailed in Wall Street Survivor, has shaped every part of how McDonald's and its competitors operate. Here's how it works in practice. McDonald's owns about 45% of the land and 70% of the buildings at its 36,000-plus locations worldwide. The company's real estate holdings are valued at around $42 billion, making up about 80% of its total assets. Instead of relying solely on food sales, McDonald's corporate collects rent from franchisees, who operate most locations. In 2021, McDonald's brought in $13.1 billion from franchisees, with $8.4 billion, about 62% of its total revenue, coming directly from rent. The rent typically ranges from 8% to 15% of a franchisee's gross sales, according to Investopedia and Your Story. This steady income insulates McDonald's from the ups and downs of the fast food market. For franchisees, the financial commitment is steep from day one. Opening a McDonald's usually requires $1 to $2 million upfront. That includes a $45,000 franchise fee, about $1.5 million for equipment, which must be purchased from approved vendors, and $500,000 in working capital. After securing the location, franchisees pay McDonald's 4 to 5% of gross sales as royalties, plus another 8 to 15% in rent. Once labor, food, and other expenses are paid, franchisees average about $150,000 in annual profit per location. Meanwhile, McDonald's corporate nets around $290,000 per store in pure profit from rent and fees alone. The company's approach to real estate is methodical. McDonald's real estate team studies traffic patterns and demographics before buying land, often securing prime corners years before any restaurant is built. The payoff can be enormous. For example, a Chicago lot purchased for $60,000 in 1955 now generates $1.5 million in annual rent. Corporate sometimes shifts properties between subsidiaries, inflating book values while keeping ownership in-house. This internal movement means your neighborhood McDonald's might have changed hands on paper several times, though it's always under corporate control. Once a franchisee is in, the lease terms are long and demanding. Most leases run for 20 years with automatic extensions, locking owners into decades of payments. Rent starts around $22,000 per month, but often climbs each year. In high-cost markets like California, some franchisees pay more than $40,000 a month just to use corporate-owned land and buildings. These rents can eat up 10 to 15% of total sales, which is much higher than what most independent restaurant tenants face. The risks are real for local owners. A Texas franchisee shared that he pays McDonald's $396,000 a year in rent before making any profit. Another spent $1.8 million renovating an old site, only to see corporate approve a new McDonald's just half a mile away. If sales dip or costs rise, corporate can terminate a lease and resell the location to a new operator, collecting another $45,000 franchise fee in the process. Franchisees have little leverage. If they walk away, they lose their entire investment. McDonald's profits from every angle. Franchisees are required to buy everything from napkins to point-of-sale systems through corporate-approved suppliers, often at a markup. Audits have found corporate making over 100% profit on some of these supplies. Equipment is leased through McDonald's own financing arm at above-market rates. Loyalty program redemptions come out of the franchisee's pocket, with corporate keeping the full purchase price while local owners cover the cost of free food. Several franchisee groups have alleged exploitative practices. According to Retail Wire, claiming that corporate policies and accounting methods stack the deck against local operators. The company's real estate strategy explains a lot about the fast food landscape. McDonald's operates in tiny towns with few customers because it owns the land, turning even underperforming locations into steady rent generators. Frequent rebuilds and renovations aren't just about keeping up appearances. New buildings allow corporate to justify higher rents. When multiple McDonald's pop up in the same area, it's often because corporate owns the surrounding real estate, using the restaurant as an anchor to boost the value of nearby properties. Other fast food giants have followed McDonald's lead, though few match its scale. Burger King owns about 10% of its locations outright and leases another 25% to franchisees. Yum Brands, which includes KFC and Taco Bell, uses a similar model but with less direct control, resulting in lower profitability. Starbucks resisted this approach for years, but now owns about half of its U.S. locations. The more real estate a company owns, the more predictable its earnings become, no matter how food trends shift. Franchisees increasingly push back. Some owner groups calculate that McDonald's extracts over 40% of each location's revenue through rent, royalties, and required purchases before even considering food costs. Others argue that McDonald's makes more money selling franchises and collecting rent than it does running company-owned stores. These tensions have led to lawsuits and public disputes, with franchisees accusing corporate of manipulating accounting to inflate rent percentages and charging for unnecessary renovations and tech upgrades. The pandemic put this model under a microscope. With dining rooms closed, franchisees asked for rent relief, but McDonald's only offered temporary deferrals, demanding back payments with interest later on. Some franchisees went bankrupt, while corporate posted record profits thanks to a surge in delivery orders. The structure of the business meant that rent and royalty streams kept flowing to corporate, regardless of local struggles. Rural and small-town franchisees often feel the most pressure. As sales decline, corporate rarely adjusts rent percentages downward. In one Nebraska location, rent jumped from 8% to 12% of sales after a property reassessment, even as customer counts dropped. Owners say the system expects underperforming stores to subsidize high-traffic urban locations, using the rent structure to keep overall revenue stable for the corporation. Commercial real estate experts often point to McDonald's as a model of efficiency. The company boasts a 99.5% occupancy rate across its properties, a figure most traditional landlords can only dream of. This stability comes from the strict requirements and financial commitments placed on franchisees, ensuring that rent keeps coming in even during industry downturns. This approach also explains why fast food chains continue to expand, even as sales per location stagnate. For corporate, opening new franchises is always profitable. The $45,000 franchise fee, equipment sales, and guaranteed rent outweigh any risks of market oversaturation. That's why you might see several McDonald's in the same town. Corporate profits from each one's existence, regardless of whether there's enough demand for all of them. The rise of ghost kitchens takes this real estate strategy to a new level. McDonald's and other chains now operate delivery-only locations that pay corporate rent without needing seating areas or drive-thrus. These virtual restaurants have higher margins and lower overhead, maximizing returns on real estate investments. Some analysts expect future growth to come mainly from these hidden kitchens, as traditional locations face slower growth. Every aspect of the McDonald's experience traces back to this real estate model. Uniform building designs are easy to mass-produce on corporate-owned lots. Streamlined menus maximize kitchen output per square foot. Even the iconic golden arches serve as landmarks that boost property values as much as they attract customers. Ray Kroc's insight was simple: land appreciates, food does not. That principle still drives the business today. But this relentless focus on real estate and efficiency comes at a cost. The drive for uniformity and cost savings has reshaped the look and feel of fast food restaurants everywhere. The next time you walk into a newly built location, you might notice they all seem to share the same bland, boxy design. That's not a coincidence. It's a direct result of corporate priorities. And it sets the Bland Box for a new question. Across the fast food landscape, memorable a new kind of sameness has taken hold. What many call the Bland Box Takeover. Walk into a recently built McDonald's, Burger King, or Wendy's, and you'll notice the same gray walls, neutral tones, and flat-panel digital menus. Gone are the days of playful arches, castle turrets, or cozy red roofs. Now, nearly every new location follows a stripped-down corporate prototype, with exterior design elements reduced by 40% to cut costs, as shown in decision documents from Restaurants Canada. The result is a sea of minimalist boxes, each designed for efficiency and consistency rather than personality. This transformation didn't happen overnight. In the 1980s, fast food brands began moving towards standardized designs to save money and simplify operations. The trend accelerated as digital menu boards replaced the unique facades and playful interiors of previous decades. According to a Retail Insider review of the Canadian market, these changes were driven by the need for speed and scalability. Today, construction documents reveal that generic layouts cost about 30% less to build than the themed restaurants of the 1990s, and maintenance expenses are 40% lower on average. Standardization allows chains to deploy new locations in under 3 months, compared to a year for custom builds, a clear advantage in a competitive market where every week counts. Franchise agreements now mandate strict adherence to corporate design standards. Owners must follow detailed guidelines down to the paint color and floor tile. One Burger King operator was fined $15,000 for using the wrong shade of gray on the exterior. McDonald's requires identical kitchen layouts worldwide, even when local staff say it's less efficient for their market. This uniformity ensures brand recognition, but comes at the expense of architectural diversity and local adaptation. Inside, the changes are just a start. Classic features like playgrounds, jukeboxes, and booth seating have disappeared. Hard chairs replace booths to discourage lingering, making way for faster turnover and higher hourly sales. Some locations have removed trash cans entirely, shifting waste management to staff to streamline cleaning and reduce labor costs. The focus is on throughput, how many customers can be served per hour, not on creating a welcoming environment. Digital menus play a major role in the modern fast food experience. Chains can adjust prices in real time, raising costs during peak hours and rolling out limited-time offers to create artificial scarcity. Menu engineering pushes higher-margin items through strategic placement, a tactic that wasn't possible with static boards. These changes might make operations more efficient, but they also contribute to a sense of detachment and impersonality. The move toward automation further erodes the human element. Self-service kiosks have replaced many cashiers, upselling automatically with every order. In the kitchen, staff often work behind frosted glass, minimizing direct interaction with customers. Some drive-thrus now use AI voice ordering, removing even the basic exchange between worker and guest. In a leaked presentation, a McDonald's executive described employees as the most unpredictable cost center, a sentiment that explains the push to automate wherever possible. Some chains have taken this approach to the extreme. In California, a Chick-fil-A location was built without any dining seats, offering only pickup shelves and a drive-thru. Dark kitchen models, restaurants that exist solely to fulfill app orders, are becoming more common. One Burger King in Brooklyn consists only of vending machines and a QR code, with no staff visible to customers. The physical space itself has become secondary to the need for efficiency. Customers have noticed. The American Customer Satisfaction Index, ACSI, found that satisfaction scores fall by 15% when locations replace unique designs with generic layouts. The 2024 ACSI report also links declining consumer excitement to the lack of personality in new stores. Many people miss the playful features and memorable architecture that once defined their favorite fast food spots. Review sites consistently show higher ratings for older locations that retain traditional designs, and some travelers seek out vintage Pizza Huts or Wendy's for nostalgia and photos. Franchisees have little choice in the matter. Lease agreements often require renovations every decade, and any deviation from the approved design can result in fines or even the loss of the franchise. Attempts to preserve classic elements, like a Whataburger owner who kept a 1970s orange roof, are rare and usually short-lived. As leases come up for renewal, holdouts are forced to conform or risk losing their business. The psychological impact of these changes is significant. Studies show that colorful, playful environments boost mood and satisfaction, yet fast food chains continue to opt for sterile, minimalist spaces. One marketing professor refers to this as the IKEA effect, where bland surroundings train customers to accept a mediocre experience as normal. The food might be the same, but the sense of occasion and fun is gone. For younger generations, the transformation is almost complete. Teenagers today are unlikely to remember birthday parties under bright arches or afternoons spent in themed playplaces. Now, fast food is just another transaction, efficient but forgettable. The industry's focus on maximizing throughput has come at the expense of the magic that once made these places special. Corporate surveys often frame the new designs as a response to customer demand for cleanliness and convenience. However, these surveys rarely ask about the loss of charm or personality. The real story appears in the data. Locations that retain some classic elements outperform the new sterile boxes by 15% in customer satisfaction, according to ACSI scores. Yet, with profitability as the guiding principle, satisfaction often takes a back seat. Even so-called retro locations are typically just facades. Chains sometimes build replicas of old designs as marketing stunts, but behind the vintage signage and neon, the interiors are identical to every other store: gray walls, digital menus, and streamlined kitchens. Energy-saving measures, like turning off neon signs during the day, further diminish any sense of authenticity. This standardization is now a global phenomenon. A new McDonald's in Dubai looks almost identical to one in Des Moines. While menus may adapt slightly to local tastes, the buildings do not. Corporate leaders determined that maintaining regional architectural diversity was too costly. A single prototype now serves every market, maximizing profit per square foot. Some chains resist the trend in small ways. Chick-fil-A occasionally uses brick exteriors, and Shake Shack's modern designs feel intentional rather than purely cost-driven. But the overall direction is clear. The industry is moving toward total homogenization. Within a decade, nearly every fast food restaurant may look and feel like every other, a landscape of gray boxes and glowing screens. For many customers, this shift means the loss of something intangible. The excitement, the sense of place, and the little touches that made fast food an experience rather than just a meal have faded. Kids no longer beg to visit for the playground or the cool building. Instead, fast food has become another quick stop between activities, a transaction stripped of wonder. Yet, not every brand has followed this path to the letter. One chain stands out by holding on to its quirky identity while still thriving in a market obsessed with efficiency. While most competitors have embraced the bland box model and relentless price hikes, this outlier manages to keep costs down, menus fresh, and customers engaged. Their approach raises an important question about what's really possible in fast food, and whether the industry's current direction is the only way forward. Taco Bell, the fast food rebel. Taco Bell stands out as the fast food industry's most unconventional player. While competitors steadily push prices higher and shrink their menus, Taco Bell takes a different route, focusing on value and innovation, and doing it with a consistency that's rare in the business. This isn't just marketing spin. The brand's refusal to abandon affordable options and its relentless pace of new menu ideas have earned it a reputation as the category of one, a phrase CEO Sean Tresvant uses to describe Taco Bell's unique position in the market. The numbers back up this claim. In 2024, Taco Bell's U.S. same-store sales rose by 5%, outpacing most other major chains. Digital sales jumped 7%, and the loyalty program saw a 17% boost in users. For the first time, Taco Bell crossed $1 billion in profit, and its company-owned stores posted restaurant-level margins north of 24%. These aren't just statistical blips. They show a brand that's growing even as other fast food giants struggle with slowing traffic and customer fatigue. Parent company Yum! Brands now relies on Taco Bell for the majority of its U.S. profit, and it's clear why. Taco Bell manages to keep prices reasonable and quality steady, even as the rest of the industry faces backlash for rising costs. What sets Taco Bell apart begins with its approach to value. At a time when most chains have quietly retired their value menus or loaded them with smaller portions and higher prices, Taco Bell's Cravings Value menu still features 10 items at $3 or less. This isn't a marketing gimmick or a limited time offer. It's a core part of their business model, and it's supported by research from QSR and the Food Institute, showing that Taco Bell's value menu attracts price-conscious diners who might otherwise skip fast food altogether. The spicy potato soft taco, cheesy roll-up, and other low-cost fan favorites aren't just leftovers there, promoted and refreshed regularly to keep the menu feeling accessible. This dedication to value is paired with a nimble, relentless innovation cycle. Taco Bell introduces about 10 new products each year, after testing 40 to 50 concepts with real customers. Recent launches like the Cheesy Street Chalupas and Cheez-It collaborations aren't just headline grabbers. They're the result of a process that rewards experimentation and quick pivots. The upcoming carnitas-style shredded chicken is just one example of how Taco Bell keeps its menu fresh, giving regulars something new to try without abandoning the classics. This constant churn of ideas keeps customers engaged and encourages repeat visits, a tactic that's especially effective with younger diners who crave variety. Taco Bell's value menu isn't an afterthought or a way to lure people in for upsells. It's central to how the brand builds loyalty. The menu architecture allows customers to mix and match low-cost items with higher-priced specialties, creating a sense of choice and control. You can grab a cheesy roll-up for $1 or splurge on a specialty burrito without feeling like you're being forced into a pricey combo. This stands in contrast to other chains, where value often means smaller portions or convoluted bundles that end up costing more. Digital engagement is another area where Taco Bell leads. Rather than using technology solely to drive up ticket sizes or push add-ons, Taco Bell's app and loyalty program focus on making things easier and more rewarding for customers. The app streamlines order customization, and digital deals are straightforward. No hoops to jump through or confusing point systems. The loyalty program actually delivers real value, with free food and exclusive offers that don't require excessive spending. Taco Bell's investment in drive-thru voice AI, now live in over 300 US locations, has already processed more than 2 million orders, showing the brand's commitment to improving speed and accuracy without sacrificing the customer experience. Store design at Taco Bell also breaks the mold. Instead of rolling out a single bland prototype, the brand experiments with concepts like a 2-story location in Minnesota that uses elevators to deliver food to drive-thru customers. Smaller go-mobile stores focus on drive-thru and delivery efficiency, but still retain touches of personality. Employees are given exclusive merchandise through collaborations with streetwear brands, fostering a sense of belonging that's often missing at other chains. These details may seem minor, but they add up to a work environment and customer experience that feels more inviting and less transactional. Marketing at Taco Bell is built around the idea of being a cultural rebel. Campaigns like the effort to free the phrase Taco Tuesday from trademark restrictions show a willingness to take risks and connect with fans on a cultural level. Collaborations with celebrities and influencers aren't just for show. They're designed to make customers feel like they're part of a larger community, not just another transaction. CEO Sean Tresvant has described this as making customers feel like insiders, a strategy that's paid off with increased engagement and brand loyalty. International expansion is another area where Taco Bell's approach stands out. Instead of simply cloning its US stores around the world, Taco Bell adapts its menu to local tastes while maintaining the brand's core identity. Plans are in place to reach over 3,000 locations outside the US by 2030, with new markets in France, Greece, and South Africa, and continued growth in the UK, Spain, Australia, and India. This flexibility allows Taco Bell to succeed in diverse markets, something not all fast food brands manage well. Behind the scenes, Taco Bell's kitchen operations are designed for efficiency and flexibility. Core ingredients like beans, cheese, and seasoned beef are used in multiple menu items, keeping costs down and prep times short. Limited-time offers are created by remixing existing ingredients, so the brand can launch new products quickly without overhauling the supply chain. This modular approach lets Taco Bell keep prices low without sacrificing quality, a balance that's rare in the industry. Franchisees benefit from this system, too. Taco Bell's franchise model is structured to support innovation and profitability, rather than maximizing rent extraction. Store owners report higher profits compared to many competitors, and they praise corporate leadership for encouraging experimentation instead of mandating costly remodels or squeezing margins. This partnership approach has paid off, especially during challenging times like the pandemic, when Taco Bell provided flexible lease terms and marketing support to help franchisees weather the storm. Employee experience is another area where Taco Bell sets itself apart. While not perfect, the company offers better training and advancement opportunities than many competitors, with some locations providing clear management tracks and internal promotion programs. This Start With Us, Stay With Us initiative encourages employees to build careers within the brand, helping to keep turnover lower than the industry average. Taco Bell's approach to menu psychology is subtle but effective. Combos are priced so that buying a box feels like a smart deal, not a ripoff. The $5 Cravings box, for example, includes a drink, taco, burrito, and chips with cheese, offering more food for less money than many single-item meals at other chains. This strategy builds goodwill and keeps customers coming back, even as prices at other chains climb. Limited-time items and menu changes are handled with an eye on customer satisfaction. When supply chain issues led to a shortage of Mexican pizza, Taco Bell responded by bringing it back permanently and improving distribution. The brand's willingness to listen to fans and adapt quickly has helped it avoid the backlash that often follows abrupt menu cuts at other chains. Technology and merchandising also play a role in Taco Bell's success. Self-service kiosks are used to improve order accuracy and free up staff for more complex tasks, rather than simply cutting labor costs. The brand manages delivery in-house where possible to avoid excessive third-party app fees. Merchandise drops, like hot sauce packet sweaters and streetwear collaborations, build community and keep the brand top of mind beyond just food. Ultimately, Taco Bell's consistent focus on value and innovation has allowed it to grow average unit volumes by 40% over the past decade, while keeping price increases below the rate of inflation. Customer satisfaction scores regularly lead the industry, and the brand's ability to attract price-sensitive diners without sacrificing profitability stands as proof that a different model is possible. Taco Bell's example shows that when a fast food brand prioritizes real value and continuous innovation, it can thrive, even as competitors struggle with shrinking traffic and rising costs. The chain's steady growth and strong customer loyalty offer a sharp contrast to the rest of the industry, where higher prices and declining satisfaction are becoming the norm. But Taco Bell's success also highlights a broader problem. When one of the only places left to find a full meal for a few dollars is the exception, not the rule, it signals that something much bigger is going on. Rising fast food prices have become a clear warning sign about the state of the economy. The numbers don't just show a few menu items creeping up. They reveal a system-wide shift that's changing how people eat, spend, and think about what used to be an everyday treat. Start with the basics. Since 2014, fast food prices have surged 63%, compared to a 31% rise in the overall consumer price index. That's not just a little faster. It's double the rate of general inflation. Grocery prices, by comparison, are up 31% over the same period. According to Deloitte, this rapid escalation in fast food costs has left many consumers feeling squeezed, with some menu staples, like a McDonald's cheeseburger, now double their 2019 price. The McChicken, for instance, has climbed by more than 200%. These price hikes aren't just isolated to one chain or one city. They're everywhere, and they're hitting the wallets of people who once relied on fast food as a budget-friendly option. The impact is obvious in how people are changing their habits. A LendingTree survey found that 78% of Americans now see fast food as a luxury. That's a dramatic shift for an industry that built its reputation on being affordable and accessible. More than 6 out of 10 people, 62%, say they're eating less fast food because of rising prices. 3 out of 4 believe it's now cheaper to eat at home, a reversal from trends that held for decades. McDonald's executives have even acknowledged that low-income customers are choosing to cook at home more often, something that would have been unthinkable just a few years ago. Dig deeper, and you see the divide growing. The American Customer Satisfaction Index shows that restaurant customers now skew toward higher incomes and more education. Fast food, once the go-to for working families and students, is increasingly catering to college grads and six-figure earners. The original customer base, the people who made dollar menus famous, are being priced out. Even at chains like Five Guys, a single meal can eat through $15 without much thought, while Taco Bell stands out as one of the last places to find true value. Delivery apps have only made things more complicated. Ordering through DoorDash or Uber Eats can double the cost of a meal once fees and tips are added. A $6 burger suddenly becomes an $18 delivered splurge. These platforms have normalized higher prices, and restaurants have responded by raising menu prices across the board. even for in-person customers. The convenience comes at a steep cost, and now everyone pays more, whether they use delivery or not. Workers feel the pinch as well. Fast food wages have risen about 24% since 2019, but menu prices jumped 53% in the same period. That means a worker earning $15 an hour needs to work almost an hour to buy a single Chipotle bowl. In California, where some fast food workers now make $20 an hour, employees still report packing lunches because a $12 combo meal wipes out too much of their paycheck. The argument that higher wages are to blame for rising prices doesn't hold up when corporations simply pass every cost increase along to the consumer, keeping profits high and leaving workers in much the same position as before. Corporate profits remain robust. McDonald's margins recently hit 23%, higher than in previous decades. Restaurant Brands International, which owns Burger King and Popeyes, reported $1.6 billion in profit last year. Franchisees, meanwhile, struggle with shrinking margins and lower foot traffic, even as corporate headquarters push for more price hikes under the banner of premium menu innovation. The focus on maximizing shareholder returns has driven a cycle where prices rise faster than costs, and the original promise of affordable fast food gets lost. The psychology of eating out has fundamentally shifted. Millennials remember $1 burgers as a cheap indulgence. Gen Z only knows $6 versions that require budgeting. What was once an impulse by now feels like a calculated luxury, more like splurging on a daily Starbucks than grabbing a quick bite. Families have changed their routines, too. Viral posts show parents swapping $50 weekly McDonald's runs for home-cooked meals. School teams skip post-game fast food stops because feeding a dozen kids costs $200. Even road trips now mean packing coolers instead of hitting the drive-thru. Higher earners aren't immune. Households making six figures have cut their fast food visits from 3 times a week to just once. When a combo meal costs $14 and the fries are cold, many wonder why not spend a couple dollars more at a local diner for better food. Fast food has lost its speed and price advantage at the same time, making it less attractive for everyone. The trend isn't slowing. The USDA's food price outlook forecasts that food away from home prices will rise another 3.6% in 2025, compared to just 2.5% for groceries. At this pace, a Big Mac meal could easily hit $20 within a couple of years. Meanwhile, grocery inflation is slowing to just over 1% annually, making home cooking the clear winner for cost and quality. This isn't just about the price of a hamburger. It's a signal that wage growth and corporate profits are moving in opposite directions. Fast food worker pay has lost about 24% of its purchasing power over the past few decades, according to background research. CEO pay, on the other hand, has soared, with executives earning hundreds or even thousands of times more than their average employee. The average McDonald's franchise brings in $150,000 in profit per year, but pays corporate $290,000 in rent and fees. The business model is built to extract wealth upward, all while using inflation as a convenient cover. People are adapting in creative ways. Social media is full of tips for hacking value menus, using apps for discounts, and splitting meals to stretch dollars. When communities share strategies just to afford a basic burger, it's a sign that the social contract around food and affordability is fraying. Regional price differences only make things worse. A cheeseburger might cost $2.19 in Iowa, but $4.50 at a New York City airport. Even rural locations with lower rents and wages have raised prices, as corporations take advantage of captive audiences with few alternatives. International comparisons highlight that this isn't inevitable. In Denmark, McDonald's workers earn about $22 an hour with benefits, yet a Big Mac costs 17% less than in the US. In Australia, fast food employees make $21 an hour, and meals cost 30% less. This shows that higher wages don't automatically lead to sky-high prices. It's unchecked corporate strategy that drives the difference. The middle class is disappearing from fast food dining rooms. American Customer Satisfaction Index data shows chains now cater mainly to higher-income customers or those who need the convenience, leaving out the families who once made fast food a weekly treat. The shift is subtle but significant. The affordable treat is no longer affordable for many. Financial stress shows up in unexpected ways. Steakhouse sales have increased while fast food struggles. Not because people are suddenly wealthier, but because $25 for a quality meal feels more reasonable than $15 for a mediocre one. Luxury brands succeed by delivering value, while fast food loses ground by offering neither savings nor speed. Franchisees see the writing on the wall. Some McDonald's owners report a 20% drop in customer visits since 2021. Burger King franchisees note that every price hike brings fewer customers through the door. These businesses depend on high volume to survive, but corporate headquarters keep pushing for short-term gains at the expense of long-term stability. The explosion in delivery app use has only fueled the problem. At many chains, app orders now make up over 30% of sales. But when a $10 meal turns into $22 after fees, customers eventually push back. Uber Eats and DoorDash saw sales growth slow sharply in 2023 as more people hit their limit on delivery costs. Labor shortages are another symptom. Fast food jobs pay 24% less than other service industry positions, and turnover exceeds 150% per year at some chains. It's hard to staff restaurants when employees can't afford to eat the food they serve. Chains like Chick-fil-A show that better pay and staffing lead to better service and faster lines, but most brands continue to cut labor to protect margins. Economic uncertainty makes all of this more precarious. TransUnion reports that credit card debt is at a record high, $1.13 trillion, and financial pressure is spilling over into restaurant spending. When households have to choose between paying bills and grabbing a quick meal, fast food is one of the first things they cut. Even McDonald's has reported sales declines among price-sensitive customers. The business model that depends on high volume can't survive if it becomes a luxury. The old logic was that fast food would thrive during tough times. In the 2008 recession, chains saw booming sales as families traded down from full-service restaurants. Today, even dollar stores are seeing slower sales as low-income shoppers pull back. When the affordable option becomes unaffordable, the entire economic safety net starts to unravel. Some brands are trying to adapt. Taco Bell has kept real value options on the menu, and McDonald's has started testing $5 meal deals after franchisees pushed back against endless price hikes. But these moves feel like temporary fixes rather than real solutions. The incentives still favor raising prices and squeezing every last dollar from customers until something gives. The warning lights are hard to ignore. Credit card balances keep rising, more Americans live paycheck to paycheck, and auto loan delinquencies are up. Now even fast food, the last affordable indulgence for many, feels out of reach. It's not just about missing cheap burgers, it's about the consequences when. Every company raises prices simply because they can, not because they need to. When raises are erased by higher costs, and a basic meal becomes a financial decision instead of a simple choice, the system is out of balance. The $20 combo meal isn't just a menu problem, it's a symbol of deeper economic trouble. Profits hit records while workers and families struggle to keep up. The industry calls itself essential, but the people who keep it running are often the first to feel the pain when costs rise. Every time you decide where to spend your money, you're making a statement about what matters. There are alternatives, and some chains prove you can offer value and pay workers fairly. But until the broader system changes, the pressure will keep building. The story of fast food is now a story about the economy itself, and what happens when the promise of affordability breaks down. That's why what you do next matters. The reality is that fast food has changed. It's no longer fast, cheap, or consistently good. This shift isn't just about higher prices or slower service. It's the result of corporate decisions that prioritize profits over value and quality. As fast food becomes more expensive than cooking at home, many people are rethinking what's actually worth their money. You have options: choosing to cook, supporting local restaurants, or seeking out brands that still offer real value can make a difference. Where you spend your money sends a clear message about what you expect from the industry. Change happens when enough people demand something better.